Have you ever wished you could finance multiple properties under one loan? Well, what if I told you that I just closed on financing for 10 new builds under one loan? Or I financed 100% of the purchase and renovation of a property using the power of what we're going to talk about in this video, which is a blanket loan. Blanket loans are an amazing tool because it can allow borrowers to save costs. It can allow borrowers to grow, and not just grow, it can grow and scale your business by multiples if you understand how to effectively use blanket loans. So what is a blanket loan? And simply put, it's one loan secured by multiple properties. And it can come in multiple different, let's call it facets of this business. You could be buying a portfolio of, say, 10 properties, and you could come to me and I'll finance the purchase and rehab of all of those properties under one loan. You could come to me and say, hey, I want to build 10 single-family houses, buying one piece of land or 10 lots. Either way, we'll finance the purchase of the land and 10 houses to be built simultaneously or one by one. But the fact of the matter is you're able to do one transaction and close on multiple properties, which saves you money. It saves you time a lot of the times because you're dealing with one lender, you're dealing with all of these properties under one roof, and you're getting the benefit of a single payment, which can simplify things for you as an investor looking to grow. My investors use blanket loan programs for very obvious transactions like a portfolio transaction, where a blanket loan program is a natural program for a portfolio purchase, right? You're buying multiple properties under one contract or multiple properties under each their own individual contract that all have the same closing date. You're able to basically go in and finance all of those properties all at once using a blanket loan and carve out individual loan amounts for each property. So not just the overall loan is spread out amongst the properties, but each individual property has its own allocated loan amount. So each can be refinanced on their own and sold on their own. So one of the biggest factors I think investors use blanket loans is for the simplicity and the asset management and just the efficiency of having a single loan with a single payment, with a single lender to talk to about construction draws, loan payoffs, etc. It just consolidates everything under one roof. It makes everything go more efficiently, not just to a close, which is clearly going to happen quickly and oftentimes within 10 days, just like a regular, let's call it fix and flip or new construction loan. But it's also going to be fast through the post-closing processes like the draw process. And that's a big factor for builders looking to scale. So let's talk about fix and flips, right? Let's say you're an investor with all your money tied up in a property that you just renovated and it's on the market to be sold. It's not sold yet. You can't access those funds, all that profit that you know you'll eventually get in the next month or two when it closes. But right now you've already identified the next property that you want to buy and you don't have any time to wait. Well, at the end of the day, a blanket loan can be a perfect program for that because I can make a loan for 100% of the purchase and rehab of your next flip, tapping the equity in the existing flip. So we're going to come in and we're going to make a first mortgage on the existing flip of enough of a loan to qualify for your skin in the game for the purchase and rehab of the next property. So blanket loans can be powerful for fix and flippers who are stuck with just one project looking to get into their next or to get into multiple projects all at once. Just a quick pro tip and back to the partial release provisions and why they matter. In that same example that I just outlined, if you're building those 10 houses and you sell that first house for $200,000 and that lender that you're working with takes 100% of the net proceeds from sale to pay down the loan balance on the remaining 9 houses, you, the builder, won't see any profit until you sell, probably in this case, 6 or 7 houses. I didn't run the math, but no matter what, your profit is getting deferred. And oftentimes as a builder, that can really put a strain on your liquidity and keep your working capital low, where it prevents you maybe even from following through and continuing to build through the project. So we're a lender that's going to work with you. We want to see borrowers replenish their liquidity every sale, take profits, whatever, but get the sale, keep the assets and the properties being built, and ultimately sell through. So just be aware, be careful as a borrower always, and make sure you're reading your term sheets closely for sure. So let's talk about the benefits of a blanket loan. And I just can't emphasize is this enough? The most important thing is that it's one closing, it's one payment, and it's one lender relationship. And that is going to take you not through just the closing process and hopefully quickly, and it can be done in 7 to 10 business days, but it's also going to play a major role in how you get through each of your new builds or your fix and flips, because speed through the draw process is equally as important. So the benefits are just efficiency and scalability that the blanket loan offers that has just unlocked so much potential and has grown. So let's talk about a real life example. I funded 10 builds in Florida under one loan. I'm going to use easier math so that I can explain it to you as simple as possible. But let's say it was $1 million loan to build 10 houses. Each one was to cost $100,000 to build. When each one sells, they're going to sell for $200,000 a piece. So you got $2 million in value. You got $1 million loan against 10 properties. Borrower already owned the land, so we're not advancing at closing on the land. The borrower just wants money to build each of the houses. So borrower decides to go out and build one right away. Builds his first house, sells it for $200,000. Asks for a payoff letter. We go and we issue a payoff letter for $120,000. The borrower gets the $200,000 net of closing costs at close, pays down the individual loan on that particular asset. The allocated loan was $100,000 like we talked about, and then takes the other 20 and pays down the balance on the remaining 9 houses. The borrower was able to build one house, sell it, pay it down, take profits off the table, and pay down a little bit towards the remaining 9 houses, leaving an $880,000 balance on the remaining 9 houses. Each one will then be built and sold and will follow the exact same process until such time as the loan is paid off and whatever balance is at zero, and now you have the remaining houses as 100% profit as a builder. I talk a lot about exit strategy on the channel and how important it is for investors to understand their exit strategy and make sure that they can convey it to their lender, because lenders are also going to be looking at your ability to exit, right? We talk about experience and how hard money lenders underwrite experience and focus on that more so than, a borrower financial proctology exam. Well, at the end of the day, you as an investor should also be focused on exit. And in regards to blanket loans, one of the key aspects of a blanket loan is what's called a partial release. It's understanding you, the borrower, understanding partial release provisions, because what we know is that you're getting one loan from the lender blanketed across multiple properties. Well, each one of those properties will be sold or refinanced. They're going to be hyper focused on what am I going to do to sell or refinance out to maximize profits. If one loan is being made across multiple properties and you intend to sell or refinance them in part, well, then you need to understand what partial release provisions are. And what those are is your ability to effectively pay off a single asset within a blanket loan for an amount. Other lenders, like asset-based lending, as an example, will allow you to take profits from the sale or refinance of, let's call it property number 1 in the blanket. You, the borrower, will be required to pay 120% of that allocated loan amount for that property in order for us to release that property from our collateral pool. Blanket loans let you scale faster without multiplying the headaches. And you can use blanket loans to get creative. You can buy portfolios, you can build multiple houses all at once. I can't stress how, if structured correctly, blanket loans can really allow investors to scale and builders to grow beyond what they ever imagined they could do. So listen, if you ever have any more questions about blanket loans, please don't be shy. Leave a comment. If you like the content, subscribe. I appreciate it. I'm going to be talking all about hard money loans on this channel and how blanket loans and other creative solutions can really drive your growth as an investor. So I appreciate the support, and thanks for watching.